Okay, good morning. Okay, welcome to class. Today we're going to do Chapter 6. Chapter 6 is about inventory, a few administrative announcements before we get started. This Saturday, Chapter 6 homework's due, and if you're in Section 3, which is not most of you sitting here live, there's a quiz also. The Friday sessions, I've had some requests from people because they want to do their homework before Friday morning, so we're changing the format of the Friday sessions. There's no longer Friday sessions. What I'm going to do Wednesday afternoon or Thursday sometime, I'll be recording step-by-step instructions on many of the homework problems that we don't go through in class. And the first week anyways, I'll email out those links. After that, you'll just check the YouTube channel, and each week the homework that we don't go through in class, I'll record those ahead of time so you don't have to wait till Friday for those. Okay, so we're going to start class today with a Learning Catalytics question. We've already got a lot of answers on it. So make sure you're logged into Learning Catalytics. The session ID is on the screen. It's 1821-8132. We are going to, you do need to get logged in, enter your one-word answer. And I'm going to leave it open for a minute or two. While we're doing that, we're going to get started on the Chapter 6 material. And okay, so Chapter 6 is about inventory and something called cost of goods sold. Inventory is what is on our balance sheet. It's what we offer for sale to customers. And it's offered, we hopefully buy it at one price and sell it for a higher price, which is the idea. When we sell it, it becomes cost of goods sold expense. We'll see cost of goods sold here a lot, and it's always an expense even though it doesn't have the word expense in the title. Now, inventory I think is a really neat, fun chapter, but it can be really, really complicated if you jump in without thinking about the fundamentals. So before we get started, we are going to have, I want to make sure we do some abbreviations because it's a lot to write this over and over. So beginning inventory, I will abbreviate it as BI, ending inventory, EI, and cost of goods sold is COGS. I will also tell you today that we're going to go through this very slowly. I have some real elementary examples, and it's so important that you get what we're doing today. If you don't get what we're doing today, it's going to make Wednesday just about impossible. But today I've got some real basic examples I think that will get us through this. So we have beginning inventory, BI, ending inventory, EI, and then COGS, cost of goods sold. And cost of goods sold is an expense. If you've not gone there yet, make sure that you've gotten logged into Learning Catalytics. Okay, why don't you app share? What's up? That's weird. Okay. Well, we're not going to app share. Okay, so on Learning Catalytics, you should be answering the question now. You've got about 30 seconds left to answer it. Right now we have 38 responses. So Haley, let me go back. The session ID is 1821-8132. It's a one-word answer. And again, today, just like every day so far, based on participation. You should be checking your grades in my accounting lab because you get credit for participating, not a correct answer per se. Okay, we're going to close this question in about 5 seconds. Or actually, let's just leave it open until the first one we do, okay? But so it'll be lurking out in the background there. Okay, so what we're going to do now is we are going to start with this inventory example. And again, today we're going to use these very basic examples. So highly simplified, but I think it'll give you the foundation that you need when we go into the more complicated things on Wednesday. So let's say we have a business selling t-shirts, and we started the period, we started the month with 3 t-shirts, and we bought 2 more. And we're going to continue to use the same example over and over. And again, I'm going to be watching for people to write this down, and I'm going to try to go really slow because I want to make sure that we get it. Phone number. Okay, so we started our business, we started the period, we started the month with 3 t-shirts, we bought 2 more. So the question is, how many are available for sale? How many do we have available to sell? That's actually a term when we talk about inventory, it's available for sale. Available for sale, what you're selling has to come from 2 sources. There are only 2 places to get your inventory from. Either you started the period with it, or you bought more during the period. We're talking about a retailer here. Manufacturing, it's similar, but you have a little more, a few more steps to go through. So, available for sale is a specific term. It refers to what's the most you possibly could have sold. Well, I started with these 3. I bought 2 more, so my available for sale has to be 5, right? Because all our inventory has to come from one of 2 places. Either we started with it or we bought it. So we have beginning inventory and purchases. That's what that's called. When we talk about beginning inventory, it's what we started with. Purchases are what we bought. Okay, so we have 5 available for sale. Okay, so that's the first line we'll see when we talk about inventory calculations. We'll see the available for sale. Okay, now let's say we sold 1. We sold 1 t-shirt. How many do we have left in ending inventory? Well, that's pretty easy. What we're going to do to get that number, whether you realize it or not, what you're doing is you're saying we started with 3, we bought 2 more, so we had 5. We sold 1, so we subtract 1, so then we have 4 left in ending inventory. Okay, so these are the fundamental calculations that we're doing. They're not bad. So when we go through formulas later, don't let them freak you out. That's all we're doing here is we're saying, okay, how many do we have left in ending inventory? Ending inventory has to be what we started with plus what we purchased minus what we sold. That's all we're doing there. So we're going to do these calculations over and over, and that's how fundamental they are. Okay, so now next one. So this basic inventory calculation, we've got 2 basic set of formulas for this chapter. This is one. The basic inventory calculation is beginning inventory plus purchases gives us our available for sale, the number of units sold, we subtract what we sold, gives us our ending inventory. That's one set of fundamental equations. Okay, so when you're talking about what equations do I need on my sheet, what do I need beside me when I'm doing homework or problems in class, this is one of them. There's 2 of them. The other one's very closely related. You'll see it coming up. So don't let this overwhelm you. This is very basic. We just did it. We started with 3 t-shirts to start with. We bought 2 more. We had a total of 5 available for sale. We sold 1. We have 4 left. That's all we're doing there. So these calculations are not bad. Okay, so same example, but now we're going to go at it a different way. We started with 3 t-shirts, we bought 2 more. Okay, so that's the same example, but now let's say we have 1 left at the end of the year. So before I told you we sold 1, now we say we have 1 left. So how many did we sell? Well, we sold 4, because if we have 1 left, we started with 3, we bought 2, we had 5 available for sale, we're saying we have 1 left, that means we had to have sold 4. So we can solve for this 2 different ways. Let me just show you, whoops. Let me just see where, okay. So I said there's 2 sets of formulas you need. One is solving for the number of units sold. The other one is solving for ending inventory. They're the same thing, we're just flipping it around. Do we know how many we sold, or do we know how many we have left? Whatever we don't know, we can solve for. Right here, these basic inventory formulas are what will get you through most of what we do. Okay, so we have to be able to solve for ending inventory or number of units sold. This set of formulas, which is basically the same formula, just the 2 ending terms rearranged. But this set right here is so important. It's what we're going to see over and over and over. And we can use it with dollars and with units. Right now we've got it in units. We can easily convert it to dollars. And the same basic format is going to hold true. So this is what we've done to this point. If we simply said, okay, we know we can solve for how many units we have in ending inventory or how many we've sold. Why do we need to know how many units are ending inventory? Because on our balance sheet, when we show people at the end of the period, at the end of the year, we have a balance sheet. The balance sheet says, here's all our resources. Here's the assets, everything we own. Inventory is on the balance sheet. Inventory shows how much, on the balance sheet, shows how much inventory we have available for sale. That's important for investors to see. What are we carrying in inventory? Cost of goods sold is important because income statement is sales minus cost of goods sold gives us gross profit. So income statement, we have to know how many we sold so that we can get our gross profit. We cannot do an income statement without cost of goods sold. So we need to be able to know what's on inventory on the balance sheet and what's on cost of goods sold on the income statement. Okay, so now let's go forward. So let's start putting some numbers here. So now we're going to put some dollar values on here. When we value ending inventory on the balance sheet and when we have cost of goods sold, both those numbers are based on the cost of inventory, not what we're selling it for, what it cost us. We can offer these t-shirts for sale for 30 bucks, but they're still only going to be put on our books at what they cost us. Okay? So let's go through this basic example. Assume t-shirts can be purchased for $10 each. We're going to assume in this example that price doesn't increase. So we purchase these t-shirts for $10 each. So our beginning inventory is $30 because each one we bought for $10 each. We have 3 of them, $30. Purchasers we bought to $10 each, $20. Okay? So this is our example where price doesn't change. It holds steady. So then my available for sale is $50, okay? Because we have the purchases, we have beginning inventory, 3 of those at $10 each gives us $30. Purchases, 2 of them at $10 each, $20. So my available for sale, the maximum amount of inventory I have outstanding for sale is $50. Now, my ending inventory, I have 1 unit left. I value it at cost. Cost is $10. And my cost of goods sold is the $10 times the 4 units left in ending inventory. So I said that my beginning inventory plus my purchases is $50. So what I had available for sale has to come from beginning inventory plus purchases. So my available for sale, all my inventory has to come from one of 2 places. Either I started the period with it or I bought it during the period. Now at the end of the period, all those units have to go one of 2 places. Either we had to have sold it or we still have it. So now at the end of the period, I have the $10 cost in ending inventory and the $40 cost of goods sold. Those add up and they're $50. You can have, as an aside, you can have inventory be stolen. You can have inventory evaporate depending on what it is. And that's another topic, and we're not going to complicate this with that. So know that there's ways to deal with inventory theft or breakage or whatever, but for right now we're going to assume not, because it just makes it a lot more complicated at this stage. So the thing to note here is the total cost of beginning inventory plus purchases will always equal the total cost of ending inventory plus cost of goods sold. Always, always, always. That's one of those things that will always hold true. So you do beginning inventory plus purchases equals ending inventory plus cost of goods sold. It has to hold true. And we're going to use that later as we go. Just a heads up, we're going to be closing the Learning Calories question in about a minute. Haley, close it in a minute. And paste it in the, oh, you've got it in the window. Of course. Okay, so we've got beginning inventory plus purchases equal to ending inventory plus cost of goods sold. We know that. Up to this point, there's no basic problem with inventory. Okay, it costs us $10. So we have beginning inventory plus what we purchased, $10 each. Then we have ending inventory. It has to be valued at $10 each. And what we sold is $10 each. So if this were the case, we'd probably be done with the chapter now. But life isn't like that. Now assume the cost of t-shirts can fluctuate. This is real life. Costs change. So in this case, let's assume, so now we're just putting numbers on here. Beginning inventory costs $10 each. Now during the period, the purchases cost $15 each. So the cost of t-shirts went from $10 to $15 during the period. Okay, so now we're getting to the issue here. So my available for sale is still the same. My available for sale is the 3 at $10 each plus the 2 at $15 each. Now my ending inventory. Is my ending inventory $10 or $15 each? Is my number of units sold $10 or $15 each, or some other answer? And that's where we get into the rest of this chapter, is how do we value ending inventory and how do we value cost of goods sold? We cannot leave it up to companies to just pick. I mean, right now we're looking at this and say, well, maybe it's not such a big deal. It is a huge deal for companies. Companies have billions of dollars in inventory, and if we say to companies, just do whatever you think's right, then we will not be able to compare financial statements from one company to another. We need to make sure that everyone's following the same rules of valuation. If we leave it a gray area, everyone will interpret it different. Now, it depends what I want. In this case, if I said, oh, I want my ending inventory, my cost of goods sold to be $10 because then my income will be the highest. Oh, I want that. Or I want my cost of goods sold to be the highest so I can save taxes, then I'll pick the 15. We can't leave it up to arbitrary choice. We have to have some rules so that companies all are doing the same thing, so that when we pick up financial statements, we can say, okay, we can compare Amazon to Target because we know they're using the same rules. So what we have is we have 4 different ways to solve that question about how do we value ending inventory. Companies will select a method and they will disclose what method they're using. So what I'm going to do now is I'm going to go through the 4 methods. Okay, and again, we're using this t-shirt example so we can get the hang of it with very little numbers. The problem with using the t-shirt example is you look at it and go, this really doesn't make a lot of difference. What's the difference between $10 and $12? Not that much. But keep in mind, when companies do this, we have billions of dollars at stake, and it is a big deal. So the first method we might say is, in our little example here, we might say, well, we know which t-shirt's left. So let's just say that we're told that that one t-shirt back in beginning inventory is left. That's the one that we haven't sold. Okay, well, if we're told that here's the t-shirts that's left, let's say these t-shirts have serial numbers so we know which one's left. Then our beginning inventory, so let's run through the calculations. Beginning inventory, $10 each times 3 units. Purchases, $15 each times 2 gives us total cost of $60. Okay, so what we're trying to do here is we're trying to allocate that $60 between ending inventory and number of units sold. We're told which units left in ending inventory. Okay, so that's the question we're answering is, how much is ending inventory and how much is cost of goods sold? And we're doing this using specific identification, that we can identify that which t-shirts left. Okay, I'm going to pause for a minute while I see the writing, until I see the writing stop. Now, specific identification tends to be the easiest one to answer how much is ending inventory and how much is cost of goods sold, because we're told, okay, so ending inventory in this case, it's in green and it's very hard to see, but next to ending inventory, we have 1 unit left at $10 because that's what it cost. It was in that beginning inventory. So 1 unit at $10, that's our value of ending inventory. Okay, so $10 is our ending inventory cost. So then, to value cost of goods sold, we can do it one of 2 ways. The easy way, the way I don't have written down here, but the easy way is to say, what is ending inventory plus cost of goods sold has to equal what? 60, I heard it. It has to equal 60 because that $60, the beginning inventory plus purchases is $60. So that means ending inventory plus cost of goods sold has to equal $60. If we know that ending inventory is 10 and the total has to be 60, it has to equal 50. Here's the other way to do it. We can say ending inventory, we have 2 units left from beginning inventory, so 2 units at $10 each. We also have 2 units left from purchases at $15 each for $30. So our total of our cost of goods sold has to be $50. We have 2 units left from beginning inventory, 2 units left for purchases, so we have a total of $50 there. So our beginning inventory plus our purchases will always equal ending inventory plus cost of goods sold. So if we know what ending inventory is, we should be able to subtract to get cost of goods sold, or vice versa. Okay, specific identification, which is what we just did here, where someone points to one of the units and says, this is what we have left. That's going to be our easiest method. That's going to be, this one's easy because we can actually identify it. And it's the one that makes the most sense intuitively because we think, oh, well, we know which t-shirt's left. However, specific identification method can only be used in certain circumstances. And we're going to go over those circumstances on Wednesday, but the only circumstances it can be used in is when we have serial numbers, and usually the items are pretty big ticket items, like we have serial numbers on cars, okay? Things that are cost a lot and that it's worth tracking individual units. If you're talking about thousands of t-shirts, you are not going to use specific identification. It would not be worth the cost of tracking it. A lot of times you cannot track it because things don't have serial numbers. You cannot tell where one particular one came from. So specific identification, even though intuitively it makes the most sense to us, it just simply cannot be used. If you're selling milk, for example, you cannot use specific identification because you don't know which gallon of milk this was, for example. So there's all kinds of examples of when you can't use specific identification. Specific identification means you have to track each individual unit to its ultimate purchaser, which means you have to have a unique identifier on every single item. You have to know where every single item went, and this becomes extremely costly, especially if your item itself isn't that costly to begin with. So specific identification, as attractive as it is, we really can't use it in many cases unless we're dealing with big ticket items that are unique. Okay. So then that gets us to the next method. Okay, so the next method, so working our way down into things that make sense, let's look at the average method. It's either known as the average method, or I call it the weighted average method, just to kind of say we can't just add $10 and $15 and get $12.50 because it's got to be weighted with how much is in each category. So weighted average method, we're going to go over this now. So this is the next one. So if I can't use specific identification, let me think, why don't I use some kind of average? So I'm going to take my cost of purchases and my cost of beginning inventory and average them out and use that average as my inventory cost. Okay, and this is an acceptable method. When we use it, it's a weighted average, emphasis on weighted. Okay, it's weighted to reflect how much is in beginning inventory, how much is in purchases. Okay, so let's go back. We're going to use the same example over and over. So beginning inventory, we have 3 units to start with, costing $10 each. Purchases are $15 each. So we have that. Okay, so there's our available for sale. Okay, and again, just like we did before, we know that our beginning inventory is the number of units times the cost. So we have $10 a unit times 3, $30 in beginning inventory. Purchases, we bought 2 units at $15 each to give us $30, so our total cost is $60. That isn't going to change from example to example. We're still using that same basic setup. Okay, so it is weighted average. We cannot say $10 plus 15 divided by 2. Weighted average means we need to reflect how much was in beginning inventory and how much was in purchases so we can weight it accordingly. Okay, so what we're going to do is we're going to take that total cost. Now this is at the bottom of the screen. We're going to take the total cost of $60, divide by 5 total units. We had 5 units, beginning inventory of 3 units, plus purchases of 2 units, so that's 5. So if we take the 60, divide by 5 units, gives us a weighted average of $12 a unit. Okay. So we have this weighted average of $12 a unit. That means on average our inventory cost us $12 a unit. So then when we answer the question, what's the value of our ending inventory? We have 1 unit of ending inventory at $12 each. So again, it just showed up in green and it looked better on my screen at home. So 12 times 1 is $12 of ending inventory. And then cost of goods sold, we have 4 of those units at $12 each, 48. So if I have my $12 in ending inventory plus my 48 of cost of goods sold, I'm back to the total cost of $60. So I'm back to my total cost. Again, I could have gotten just my ending inventory. I could have gotten the $12, one unit is $12, given $12, subtracted from my original total cost of $60 and gotten 48 that way. Okay, so weighted average is not bad. You just have to go through and weight it accordingly. Now we're going to do one that you're going to try. Okay, so the facts are beginning, and I'm pushing this out to Learning Catalytics at the same time. The beginning inventory, December 1st, is 10 units at $12. The purchases on December 10th were 5 units at $15, and there's 7 units left in ending inventory. Now the first question we need to answer is, how many units were sold in December? Okay? So the facts that you're given, you have beginning inventory, 10 units at $12 each, purchases, 5 units, and there's 7 units in ending inventory. So take a minute, and the first question you're going to answer is, how many units were sold? This is not a dollar figure. It's just saying how many units were sold in December, given that fact pattern. Yeah, you need to answer the question in Learning Catalytics, not in the chat window. So beginning inventory, 10 units, purchases were 5, there's 7 units left. You guys set? I'm doing a poll here. You guys good? Good? You good? Good? Okay, we're going to close this in 5 seconds. So get an answer, any answer in 5 seconds. Just any number will work to get credit. Press the number, press submit. We're going to close in 2 seconds. Okay, the answer you should have gotten was 8. And how you get to 8 is the 10 units plus the 5 you purchased minus the 7 that were left in ending inventory. So the answer is 8. Now we have 3 more questions, 2 or 3 more questions on this particular fact set. So I'm going to leave this question and go to the next one. Okay, question 2, and this is another Learning Catalytics question. What is the weighted average cost per unit? Okay. Okay, weighted average cost per unit. I think we have the same phone. I think you and I have the same phone. Yeah, that works. You guys done? Done? Okay. Done? Done? Okay, about 5 seconds left to answer. Five seconds from now, Haley. Get an answer in. Weighted average cost per unit. It's going to be 13. And how you got that is you have the 10 units at $12 each and the 5 units at $15 each. You add those up, and that's 195 divided by a total of 15 units. I get the 15 units by taking the 10 units plus the 5. So my average cost is $13. Now, the next question. So know that that $13, regardless of what you answered, if you got it right or wrong, you're going to use the $13 cost. That is the right answer. So our next question, what's the value of ending inventory? The value of ending inventory. So give that a shot. These slides that we're going over now, just so you know, are not in the slides on Blackboard. So if we're asking for this particular equation, it would not be. I don't know how to interpret that question, but I was just going to make a statement. So we're looking for the value of ending inventory, looking back at the facts to ask yourself, how many units are in ending inventory? Well, we had 7 units in ending inventory. And then what are we valuing them at? This is the weighted average method. So weighted average method, we're going to value them at the weighted average cost per unit. 5 seconds to finish on this one. Time to answer anything if you don't have it completed. 5 seconds. Okay, value of ending inventory, time to get your answer in. She's going to close it. It's going to be 91. How did I get that? $13 is our weighted average cost that we just got in the question 2, and we have 7 units in ending inventory. So 13 times 7 is going to be the 91. Now, our next question up. What is cost of goods sold? So cost of goods sold, you should be able to calculate it. There's 2 different ways you can calculate it. So take a shot at that. Okay, cost of goods sold. You've got this question up. I want to go back to question 1 just to remind you. So I'm going backwards here. Question 1. Just to remind you, question 1, how many units were sold in December? We had to calculate that. We had to calculate that as 8. So keep that in mind as you're answering question 3 or 4. What's cost of goods sold? That's where your 8 would have come from. We sold 8 units. Okay, so we sold 8 units. Our weighted average cost per unit, you know what that is, 5 seconds to get an answer in. And the answer is going to be 104, and I got that by the $13 weighted average cost times the 8 units that were sold. Okay, so far, to recap, what we've done is we've said, okay, specific identification, we're told exactly what units are sold and which ones are ending inventory. Weighted average method, we get our total cost. So we get the cost of beginning inventory plus the cost of our purchases, divide by the number of units purchased, and we get a weighted average cost, and then we use that. Okay, so those are 2 methods. Now we get into the 2 accounting methods that are typically used. The 2 that we've just done, weighted average is used somewhat, but where weighted average gets really ugly is it's fine for our situation here. But think about weighted average if you've got purchases going on every day, and then you have inventory from last period carrying into this period. So you use the weighted average from last period, and then you sell some stuff and you purchase some stuff. It can get really, really ugly, the weighted average. It's not all as clean as what we see here. So there's 2 more methods that are used, and these are the methods that are most commonly used. Okay? So the next method is called FIFO. Okay? Now I will be completely honest with you here. Now's where we get into the confusing things. Okay? And so this is where you really have to think about what's going on. So we have FIFO and we have LIFO coming up, just to preview this. So FIFO means first in, first out. Okay, so we have exactly the same set of circumstances again. If you want to write it so you have a nice fresh thing so you can write calculations on it. Same t-shirt example, but we're going to do it using FIFO. So I'm going to pause for a minute. Okay, so we have our beginning inventory, 3 t-shirts at $10 each, purchases $15 each. So our total cost is $60. That's between beginning inventory and purchases. The question we're asking ourselves is how much is cost of goods sold and how much is ending inventory. Now, FIFO. FIFO means first in, first out. That means, what that stands for is our first units in, the first units we purchased, the first units we held are the first ones we sell. Okay? So if you think about it, isn't this how they do milk in the grocery store? The oldest milk gets the first milk sold. If they always sold the newest milk, the spoiled milk would be in the back of the case. So FIFO is the first stuff in is the first stuff sold. Now, to further complicate this, when I just compared it to milk, you can think about it in your head like milk because our first units in are the first ones we sell. But you can use FIFO for any inventory. A company doesn't have to match its inventory method to the product. This is simply when we pick an inventory method like FIFO or weighted average, we are picking an accounting cost flow only. So it doesn't matter what physically is happening with the product. Okay, so let's say, so our goal here is to figure out how much is cost of goods sold and how much is ending inventory. So cost of goods sold, FIFO, our earliest units purchased or earliest units in are the first ones sold. So cost of goods sold, those 4 shirts, remember I sold 4 shirts, those have to be from my earliest units. So I'm going to take 3 of those shirts from beginning inventory. You see where I'm getting those? My oldest shirts are in beginning inventory. So I used 3 of those from beginning inventory. Okay? So I sold by beginning inventory. But I sold 4 units. I didn't sell 3, I sold 4. So I have 3 units being sold from beginning inventory, so I have $10 times 3. So I have $30 plus, so that's those beginning inventory 3, plus then I have 1 unit I had to have sold from my purchases. So I have 1 unit from the $15 purchases. So my cost of goods sold is going to be $45. I get that because I have 3 units at $10 and I have 1 unit at $15. So we have to go back with FIFO. We go back to our oldest units, our first one sold, so we're going to keep pulling those units from our earliest units until we get to the number we sold. So we sold all 3 from beginning inventory at $10 each, and we sold 1 for purchases at $15. So my total cost of goods sold is $45. Notice that with FIFO, we don't have one cost. We don't have like a weighted average cost. We have to look at each individual purchase. So my total cost of goods sold under FIFO is $45. Okay? Now, once I get that $45, I can get my ending inventory one of 2 ways. I can say, well, my total cost is $60 and subtract the 45 and get 15. Or I can say my ending inventory, I have 1 unit. That 1 unit is $15 because it came from the purchases. It's that one that I didn't sell. So my ending inventory is $15. And again, I have ending inventory of $15. I have cost of goods sold of $45. So my total cost is $60, which equals, so my $15 in ending inventory plus my $45 in cost of goods sold will equal my $60 total cost. So I could solve for one of them and subtract for the other one. Okay, so FIFO. FIFO means you're selling your earliest units first, and you just have to go through and pick them out. So we're going to go back to our example, and you're going to get some questions so you can try it. So we're going to go on to our same set of facts. We're going to keep using that same set of example facts that you did weighted average with. We're going to do now FIFO. So now, the first question we have, this is in Learning Catalytics, is what's the total cost of inventory available for sale under FIFO? Okay, so we're answering for FIFO now. What's our total cost of inventory available for sale? Basically, this is going to be your cost of beginning inventory plus your cost of purchases. There is a question in Learning Catalytics. What's the total cost of inventory available for sale? That's the cost of your beginning inventory plus the cost of your purchases added together. Okay, total cost of inventory available for sale. This is the cost of your beginning inventory plus the cost of your purchases. Now's your time to enter an answer because it's going to close in 5 seconds. So enter any answer. The answer is 95. The answer is 95. How I got that is the cost of the beginning inventory plus the cost of the purchases. By the way, we'll see that question again when we do LIFO. The available for sale, cost of available for sale doesn't change depending on the method. That'll always be, in this example, always be 195. It's the beginning inventory plus the purchases. So now our next question, again, FIFO, first in, first out. So the oldest units are the first ones sold. So what's the cost of goods sold? So look at this, the cost of what you sold. So your first units in are the first ones sold. So you're selling your oldest units first. How many units did you sell? So take a shot at calculating your cost of goods sold, the value of your cost of goods sold under FIFO. Okay, so to tackle this one, cost of goods sold, you're looking at how many units you sold, and you're looking at valuing them at your oldest units. FIFO means the first ones you have are the first ones you sell, so the first ones out the door. So your earliest ones are those beginning inventory ones. I'm really not trying to look over your shoulder, but I am. Okay. Okay, now's the time to get an answer in. Cost of goods sold. Again, you're saying I sold 8 units. So how do you value those units? Well, you go to your earliest units sold, your earliest units that you had, your earliest units you start at beginning inventory and you work your way forward. Okay, so we're going to close this question in 5 seconds. Alexis, I'm going to answer that question for Alexis. The question is, why would the total cost of inventory available be using all of the units instead of what was available? All of the inventory was available. The inventory that we have available for sale, that we're holding for sale, is what we started the period with plus what we bought. So that's what's available. We're not saying what's in any inventory or what was sold. We're saying that here's what's available. We're holding everything that we hold for sale during the period has to either come from beginning inventory or purchases. And that's, so if you want to phrase it differently, Haley, feel free, but that's kind of where it's been. Because 7 units is not what was available. 7 units is what's left over at the end of the period, which is not the same as available for sale. The 7 units is available for sale next period, and the 7 units is actually next period's beginning inventory, but that's not where we're going with this. Okay, so did you close this one? Okay, so cost of goods sold was 96. It was 8 units. That's how many we sold, and they were valued at the beginning inventory value of 12 each. We didn't have to go any further than beginning inventory on this one because we only had 8 units sold and we had 10 units to start beginning inventory. So this one made it a little easier. So $12 times 8 equals 96. FIFO means our oldest units are sold first. When I do these, even after doing these for many, many years, if I sit down to do a FIFO problem or a LIFO problem, I actually am a very visual person. So if you ever ask me a question, you'll see I have to write it down. But next to it, when I'm working on it, I always write FIFO means my oldest units are sold first, because that helps me keep track of what I'm doing. Okay, so cost of goods sold, 96. Now the next question, what's ending inventory? There's 2 ways to get there. Ending inventory, remember that our cost of goods sold plus our ending inventory have to equal total cost of inventory available for sale. Okay, so that's one way, but the other way is to value that ending inventory. So I'm going to let you work on that for a minute or two, a couple minutes. What? What? You good now? What? Yeah, all these questions do look the same, yes. probably the easiest way to answer this one is our total cost of inventory available for sale. Everything we had available for sale was $95. We just said that of the $95, $96 is cost of goods sold. The rest has to be ending inventory. You can do this two ways, but that tends to be the easier way. So if you take the 95 minus the 96, you'll get to the answer. We're going to close this question in about 5 seconds, so get an answer in. Last chance, just enter an answer. Okay, ending inventory, two ways to get it. The easier way, I believe, is the 195 total cost minus 96 to give us 99. Or you could say that we've got 2 units from beginning inventory at $12 each and 5 units at $15 each from purchases. FIFO, if our earliest units are the ones that are sold first, our ending inventory has to be our most recent unit. So you start from the other side and go backwards. Okay, so that was FIFO. FIFO, your earliest units are sold first. Now we go on to LIFO. LIFO is the opposite of FIFO in that instead of selling your earliest units first, you're selling your newest units first. So let's go to our t-shirt example. LIFO, last in, first out. It will still have an answer even if you click change. Okay, so LIFO, same set of facts. So our total cost is $60, but LIFO means that you are if you're answering the cost of goods sold, your last in or your first out. So when we're dealing with our cost of goods sold, you're dealing with your most recent units as what was sold. In our case here, our sold units, we sold 4 units, okay? So we sold 4 units. Our green t-shirts at the bottom, we have 4 units sold. So those are our most recent units purchased. So we're going to take 2 from our purchases because that's all we purchased. We're 2 at 15. And then we're going to take 2 from beginning inventory. So we would have 10 times 2. So our total cost of goods sold under LIFO is 50 because it depends where LIFO means our newest units are sold first, so we start with our purchases and work backwards. We purchased 2 units, so we use all of those, 2 at 15, and then we have 2 from beginning inventory, so we have 2 at 10. So our cost of goods sold is $50. So then when we deal with our ending inventory, we have 1 t-shirt left. That ending inventory under LIFO has to be our oldest inventory. So 1 t-shirt at 10. So we have $10 as our ending inventory, 50 as our cost of goods sold, giving us our total cost of 60. Again, if you get one number, you can subtract to get the other. So you're starting with the other end on this. The question is, what kind of industries would use LIFO? Okay, car dealerships would use specific identification because there's serial numbers on cars and they can. Okay, any industry can use LIFO, any can use FIFO, any can use weighted average, other than specific identification because they're big dollars. So it doesn't matter what our product is. The reason companies pick LIFO is it has huge tax savings. LIFO, in periods of rising costs, LIFO will give you the largest cost of goods sold. And if you have a large cost of goods sold, you have a smaller income, you pay less taxes. Companies want to use LIFO for taxes, okay? But there's a whole different slew of reasons why you might use FIFO and LIFO. If you have international operations, you can't use LIFO because it's not acceptable. So it's a big choice about which company, and we'll talk more on Wednesday about which we might pick. But you could have any product in theory and use LIFO or FIFO. Congress is trying to outlaw LIFO right now. You know why? A revenue grab. If they get rid of LIFO, companies will owe millions and millions and millions of taxes because of switching to FIFO. So if you ever see that, that's what's going on there. Okay, so you know, as much as I love what we're doing, I'm looking and we have 3 minutes left, which just doesn't feel like enough time. So what we're going to do is we're going to stop here and we're going to start with our example on Wednesday. Okay?